All right, y'all, we're gonna get into it. Fed cuts rates. Like I said, I'm gonna share the screen real quick. We're gonna get to Old Faithful here. Also, too, I believe it was the last episode or one of those recent episodes we had dropped. It didn't seem like my mic was having issues, and all I did was, the traditional, IT troubleshooting way. Unplug it and plug it back in. So hopefully those issues have, subsided, but we'll see. All right, here we go, y'all. Get back in how I want to be. Go this way for now. Let's see how that looks on scroll. Does that mean what the text is going to be? All right, let's get into it. Fed slashes interest rates by 0.5 point. An aggressive start to its first easing campaign in 4 years. Also saw, again, probably in this article, I believe they want the rates to be, when I say the rates that they're cutting here, I think be around 2% or so in the twos. And I think that's in 2026. So we still got roughly 2 years or so until, they're actually down where the Fed wants them to be. The Federal Open Market Committee chose to lower its key overnight borrowing rate by 0.5 percentage point or 50 basis points. So when they say 0.5 percentage point or 50 basis points, so 100 basis point would be a 1 percentage point. Amid signs that inflation was moderating and the labor market was weakening. The labor market has been weakening. I don't think they ever actually deemed us to be in a recession. So technically, kind of neither here nor there, slightly related to this, but it is what it is. Also, too, they're probably saying like, hey, let's help things out before. The country is so divided right now, especially when it comes to this upcoming election. But hey, maybe the Fed's trying to do what they can. It was the first interest rate cut since the early days of COVID. We went through a whole pandemic since the last interest rate cuts, y'all. Just think about how long it's been. The committee has gained greater confidence that inflation is moving substantially towards 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance, the Federal Reserve statement said. Also, too, I'm home by myself. It's the late evening, early evening, after work. So as y'all can see, I got my energy, things like that. So I'm good to go for this episode. Washington, the Federal Reserve on Wednesday enacted its first interest rate cut since the early days of COVID pandemic, slicing 0.5 percentage point off benchmark rates in an effort to head off a slowdown in the labor market. Now, again, they're telling you this is slow down. They did this due to a slowdown in the labor market, not to help y'all asses get out here and get a mortgage. All right, because the labor market is struggling. Y'all might not need to get out here and get a mortgage, okay? Let's put some pieces together now. Anyways, with both the jobs picture and inflation softening, the Central Banking Federal Open Market Committee chose to lower its key overnight borrowing rate by 0.5 percentage point or 50 basis points, affirming market expectations that had recently shifted from an outlook for a cut half the size. Again, I believe the predictions were 0.25 basis point, like I said, so 0.25% or 25 basis points instead of the 50. Outside of the emergency rate reductions during COVID, they were emergency rate reductions, all right. The last time the Federal Open Market Committee, the FOMC, cut by 0.5 point was in 2008 during the global financial crisis. That is insane. So this is, in short, a historic rate cut. This is not just a rate cut. This is a historic rate cut. We're seeing not only the last time that the Fed cut rates was during the historic event, meaning the beginning of COVID, the last time they did it by 50 basis points or 0.5% was during the 2008 global financial crisis. So historic rate cut, not just a rate cut here, historic. The decision lowers the federal funds rate to a range between 4.75% and 5%, while the rate sets short-term borrowing costs for banks. It spills over into multiple consumer products such as mortgages, auto loans, and credit cards. Again, they can cut these rates and they can come back the next time when they're going to announce a decision on an increase or cut or a raise. As far as the rates, they could decide to raise them. This also doesn't mean that banks have to lower their interest rates when it comes to mortgages, auto loans, and credit cards that we see here for the example. This is just what the Fed has done. So in short, the banks are borrowing money from the Fed. They're loaning out to them on a certain interest rate. I believe what they say here. They say exactly what they call it. Oh yeah. Oh, I guess to lower its key. It's overnight borrowing rate. So that's what has been lowered between 4.75 and 5%. So in short, that's the money, the banks are paying as far as interest rate they're paying. And, the banks got to, in short, charge you interest so that they can make money overall and pay, people they borrow money from back and make money in FSL. In addition to this reduction, the committee indicated through its dot plot the equivalent of 50 more basis points of cuts by the end of the year. So they're talking about doing it again. So again, they're talking about doing 2 in short historic rate cuts, not only within the same year, but back to back. Okay, that's big. interesting, that's too, I mean, that's going to be right around election time, or right after, should I say. The matrix of individual officials' expectations pointed to another full percentage point in cuts by the end of 2025 and a half point in 2026. They're talking about doing a whole 1%. I mean, drastic cuts here, drastic cuts. And again, if we're at 4.75%, to get down to 2% really in less than 2 years, here's about, some point in time in 2026, you got to have some pretty significant cuts here as far as when they actually announce these cuts. And all the dot plot shows the benchmark, shows the benchmark rate coming down about 2 percentage points beyond Wednesday's move. So again, from 5%, as we're seeing, down about 2%. So 2.75 to 3% is what they're talking about here. To commit, and again, that does not mean that's what your interest rate will be for your mortgage, okay, or any loan. That's not what that means. Definitely not for your credit cards. The committee has gained greater confidence that inflation is moving substantially toward 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance, the post-meeting statement said. Here's the one thing with inflation. So inflation, by definition, is stuff going up. So we've already had large inflation, or record inflation, however you want to gauge it. And so the issue is now is, inflation may be, tampering back or going back to that 2 to 4% range, wherever they want to be at, but you've already had that large increase. So, right, so things are just not going up as much. But at the end of the day, that large increase we had in inflation, I believe, would be last year, 2023. Was it 2023 or 2022? One of those years. Anyway, inflation doesn't impact me that much. So it's hard for me to remember exactly. But when we had that large interest rate increase, in short, if your income still hasn't caught up to that inflation increase, then you're still going to be behind. Even though it's not going up as much, you still have a lot of work to do to catch up as far as a general income to inflation increase. So how much your raise is, let's say inflation was 10%, right? And your raise was 5%. All right. Now they're saying, well, instead of inflation being 10%, it's 2%, right? But even if your income still got raised another 5%, you're still behind, right? You're still not up to where it needs to be, right? Over the last 2 years, it's been up 12%. It's not exactly how percentages work as far as adding them together, and your raise is still only up 10%, right? And most people aren't getting 5% raises every single year. All right, so these are the things that you need to understand when you're seeing these rates, and they're talking about interest rates, inflation, all these different type of terms and the terminology that's being thrown out there. This doesn't mean that your income is increased at all or will increase. Hell, they said the reason they did this was due to the softening job market. I mean, damn, how much more do y'all want them to say? Federal funds target rate, July 2000 to September 2024. So we got 6% here, beginning, so July 2000, and right now 4.75 to 5%. So short, we're about at the 1% delta, but and again, you can see this is a bad chart. This is a very bad chart. In short, coming out of the dot-com, bubble, 6% down into 1% in the 2004 range, early 2000, first quarter. In this early second quarter of 2004, then it shoots up in 2006. Then we have 2007 crashing all the way down. And look how low look how low the rates were that the Fed had pretty much during / after the financial crisis, all the way up until about a little after 2015, 2016. It was under really 0.5% the whole time. Then we slowly got a rise. Right, then the pandemic happens. You see a drop back down essentially to the same levels, and then we see this is the thing too. In short, this is what I'm talking about when I'm saying they're saying inflation, isn't as much. But see, we had this big spike from 2022 into 2023. So in short, that year, and that's the part that you got to keep up with. That's what your income needs to do as well. All right, so this big increase, that's bad for you in general. All right, and your income didn't match the steepness of this graph, so you need your income to match it. All right, and again, just because in short you see it going down, that you still have to accept that in the way inflation works, there's still this increase that's been occurring this entire time.